Hey everyone, and welcome back to another video for today. So in today's video, I do want to touch on 4 stocks that I'm waiting to buy more of if the market presents a great opportunity. Because as you can see here, this is the performance of the last month. We're not talking about the performance since the start of April when everything crashed, because then it would have been dark green across the board. No, this is purely the last month. So yes, you have Microsoft that's up 19%, Meta up over 18%, Nvidia is up 25.6%, Apple is down 5%, Google up only 8.2%, green across the board, Palantir is up another 24% or so. So it was a very, very good month. I'd say a very good month and a half, right? We started April very badly, red every single day. Then around the second week of April, things started to rebound and we did experience a V-shaped type of recovery. Now the market is still not at all-time highs, the highs that we've seen back in mid-February or so. Some of these names, some of these stocks are far from their February highs or all-time highs as well. And so in this video, I do want to touch on 4 companies that I own in my portfolio, already highly ranked, some of them. 2 of those are actually some positions that I do want to increase over time. If I don't get the opportunity, then fine, then I'll increase it at higher prices. But the companies that I do want to touch on in this video are Nebius, SoFi, Google, and AMD. I know there are probably other names out there as well that if the opportunity presents itself, for example, a Mercado Libre. Mercado Libre is in my core portfolio. Great company, stock reached all-time highs, I believe, last week, $2,600 or so, now back to $2,500. The CEO is going to transition to another position, going to be executive chairman in 2026. So we'll see what happens. I just don't think that anything drastically will change with the business. But that's a company, for example, that if for some reason it goes back to around $2,000, maybe even under, I will buy more of. But we'll have to see a very, very big pullback for that to happen. And so before continuing, if you enjoy this type of videos, hit all the buttons, especially the subscribe one. We really appreciate that. We're trying to reach 100,000 subscribers. So if you're new here, hit the subscribe button. We really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. And also a special thanks to FinChat for sponsoring this video. All right, company number 1 I want to touch on is Nebius Group. Now, Nebius is a company that I've talked about back in January, but only opened up a position a couple of weeks back when, of course, we had that big pullback. Nebius has a market cap of just over $9 billion. If you don't know the whole story behind Nebius, well, they had to restructure, completely divest from their Russian business. Previously, Yandex, which was called the Google of Russia. Whether it's a good comparison or not, that's up for debate. But Nebius right now engages in building full stack infrastructure to service the global AI industry. It's growing rapidly. Now, the thing with Nebius is that, as you can see, this is quite a volatile stock, right? Year to date, it's still up. It's still outperforming by quite a lot. It's up 23.9%. But as you can see, we've seen the stock go up, then down, then up quite heavily, and then down quite aggressively, and now we've seen it recover, right? Over the past 1 month, it is up over 60%. Now, despite me being bullish in the long-term future for Nebius, I don't like to chase stocks, right? So when I see something like this, of course, I'm very happy that I bought it when it was closer to $20, and I'm very happy with the performance right now. I do still want to increase my position. In my eyes, it's still not big enough in my portfolio. So what I'm willing to do is wait it out, right? If the stock goes down and you're going to ask me the exact price, I think I answered that in a comment, but I'll say it here again. I think closer to $30 again or under, I'd be more comfortable adding more to my position. If that doesn't happen, but I get more and more information from the company, whether it's through analyst conferences, whether it's through more earnings report and earnings calls, then I wouldn't mind buying at $40 or more if the information provided makes sense. Now, if you've missed my Nebius earnings coverage, well, the video will be in top right corner, or if you just want a quick summary, we can go and look at the transcript here on FinChat, and then you just click on the AI summary. It goes over all of the transcript, not just for Nebius, but for all of the other companies out there, and it gives you a very, very good summary here, and then you can even ask it specific questions on the quarter. So revenue increased by 400% year over year. Annualized run rate revenue grew nearly 700%. They ended Q1 with a cash balance of $1.4 billion. April annualized run rate revenue was $310 million. CapEx is planned at approximately $2 billion for 2025. So yes, if you compare it to CoreWeave, much smaller, but it makes sense. But still, $2 billion in CapEx is quite a number for a company that's worth, what, $9 billion at the moment. Midterm revenue target is mid-single digit billions of dollars. Midterm EBIT margin target of 20 to 30%. The key takeaways here are strong demand and growth, strategic partnerships. We've seen those partnerships with the likes of NVIDIA, Meta, DDN, Vast, etc., etc. Global expansion is key, whether it's in Europe, the United States, or more recently in the Middle East. As for guidance, they reiterated their ARR guidance for the full year of $750 to $1 billion, and its overall revenue guidance for the group in the range of $500 to $700 million. Now, why is that important? Well, because if we go and look at the quarterly report, and by the way, it says here, while adjusted EBITDA is expected to be negative for the full year, the company plans to turn positive at some point in the second half of 2025, with the core infrastructure business expected to reach positive adjusted EBITDA sometime in the third quarter. Going back to the revenue part of it, right? Because if you go and look at the quarterly report, what does it show you here? What is it? Revenue of just $55.3 million for a quarter? How does that make any sense? Company is worth $9 billion. But they've just told us that ARR for the year is still expected to be between $750 million to $1 billion, and revenue midpoint $600 million. So 10xing what you're seeing here right now. That's why it's important to sometimes also read the transcript or the commentary from management and not only focus on a price to sales metric or just this number right here, because there are, of course, more to the story. And remember that when you're buying Nebius right now, you're basically buying the core infrastructure, the core AI infrastructure business, which, as I said before, had an annualized revenue run rate of $249 million. And they're continuing to see strong dynamic in Q2 with April ARR of approximately $310 million and have maintained this strong momentum into May as well, which is why I believe that the guidance, the $750 to $1 billion for the year, is probably going to be met and probably closer to $1 billion as well. Now remember that when you're buying Nebius today, you're not just buying the core infrastructure business, but you're also getting the other businesses out there, right? AV-Ride, Toloka, TripleTen. Those might be small today, but those can potentially be huge businesses in the future. Plus they've got a stake in ClickHouse, which was recently valued at around $6 billion. And I believe they have around 28% in that company. So imagine if ClickHouse does go public at $6 billion, or maybe they'll go public at maybe a higher valuation. Well, this will get us Nebius investors quite a lot of value, right? Because we own 28% of that company. So just remember that part. Again, I am happy with the performance of Nebius right now, but I do want to increase my position over time. Moving on to the other company, and that's of course a very popular company in the retail community. It's the number one position in my public portfolio, and that's SoFi. So why is it still on the list, even if it is already number one in the public portfolio? Well, because I still think that this is a business and a stock that is extremely misunderstood, despite them beating expectations every single quarter. And yet, the stock, the stock over the last 3 years is up 80%. The stock over the past 12 months is up 91%. Now, yes, it is true that if you look at the last 5 years, stock is only up 24.9%. And of course, if you were one of those that did buy this stock, let's say, at over $20, which again, you didn't have that many opportunities to screw up like that, right? You had way more opportunities to buy the stock under $10 than you had to buy the stock over $20. Just so we're clear. Plus, this is again a business market cap wise, $14.4 billion. I think this can be worth way more in the future because it is growing quickly. It is becoming more and more profitable. They're also expanding their total addressable market. So SoFi still on the list, although right now When will I add more? Probably if we see a pullback like we've seen before, right? If we get somehow back under $10, I don't think we're going to see that, but if we do, of course I'll add more. If we get closer to $10, $11, I'll buy more as well. Now you're saying, what's the difference between 10, 11, and well, the price that we're at right now, $13? The difference is that right now, I don't need to buy more. I don't need it. That's why the title is when we get a pullback, right? When we get a dip. Yes, I do think that SoFi in the 10s is a no-brainer for me. Now, I just quickly want to touch on two extra things here. And of course, I'll use FinChat. So if you don't know, FinChat is a stock research platform, the best one out there. I've been using it for quite a while. You've seen it in every single video. One thing that's great about it, of course, is that you can track company-specific metrics here, segments and KPIs. So with SoFi, for example, if you just want to look at the lending revenue and its growth rates, as you can see, year-over-year growth has bottomed out in March 2024. And since then, you can see that growth has started to accelerate for the lending side of the business, something that has been decelerating since March 2022, the March quarter of 2022. So we're now seeing strength in the lending business. If we go and look at the financial services one here as well, year-over-year growth rates, of course, were over 200%. So yeah, when this business becomes bigger and bigger, you cannot, well, it's very unlikely to keep on growing 200%. But here as well, over the last quarter, we have seen those year-over-year growth reaccelerate. And here we are now growing 101% year over year. And as you can see, I mean, I won't even go back that far. Let's go back just a year and a half or so ago. We can see that this segment has grown at a compound annual growth rate of 86.53%. And now, of course, with the loan platform business, which is a high margin business, lower risk, fee-based, and growing quite quickly, well, I do expect that to continue. Then, of course, I have to talk about, let's call it the disappointing part of the business right now, which is the technology platform. As you can see, the technology platform over the past couple of quarters has not really grown quarter over quarter. Year over year, very, very slow growth, right? 9.6%, 6.1%. This is a part of the business that, of course, has been disappointing, right? Even a bullish investor can admit that. But there were reasons for that, non-company specific reasons for that. And as they've told us during a conference not so long ago, and I quote, "Last night, I was looking at what deals have been announced, what deals have been signed but not announced, and what deals are pretty close to being signed that will generate revenue in 2026 Q1 that didn't generate revenue in Q1 of 2025. And there are 10 deals. Now, a couple of them may not get signed, but right now, they're high probable deals. There are 10 deals that will produce revenue in the first quarter of 2026 that produced no revenue in the first quarter of 2025. And it's been a long time since that happened. So I'm super excited about what the team has already accomplished and what we're about to roll out. So again, patience here is key." Anthony Noto, of course, also talked about the mid to long-term goals that he has internally. So we did talk a little bit more about that in another video. So that will be in the top right corner. And lastly here, of course, for SoFi, we can track members. We can track a lot of other stuff here on FinChat. But as you can see, members over the last 3 years or so have grown at a compound annual growth rate of 41.27%. Last quarter, that increased by 34% year over year, reaching close to 11 million. We're probably by now already surpassing 11 million members on the platform. If they want to reach 50 million members, well, that means that they'll continue to grow that member base quite rapidly. So all of this, of course, can be found here on FinChat, link down in the description. New users will get 2 weeks of FinChat Pro for free. Then if you really love it, you can use my link. You'll get 15% off. Thank you to everyone that has been using my link. I really appreciate that. Moving on to stock number 3, and that's AMD. AMD is a position that I started to build out this year. Now I'm over 100 shares, but I'm still not happy with the allocation. I still want more AMD shares in my portfolio. And so right now, while we are, of course, not at 120 or $122 like we've been a week and a half or so ago, we're at 110. For me to add more, two things need to happen. One, either we go back to 100 or below, I'll happily add more shares. Or two, June 12th, AMD will have their AMD AI event, which I truly hope this becomes a yearly thing, a bit like GTC, I'd say, something like that. If they actually, well, show off maybe new partnerships, new tech, well, maybe a little preview of the MI400 or something that they've been working on, something that will tell me, you know what, I don't care, 100, 110, with this information, it's worth paying that extra $10, $15 or so. So those are the two scenarios with AMD right now. It's a company that, yes, it is number 2 in the AI space competing with NVIDIA, still far from NVIDIA. I'll show you some margin things there as well. But it's a company that is operating, of course, in that industry that's worth hundreds of billions of dollars, if not more. Market cap right now, $178 billion, trailing 12 months PE of 80 times. So, of course, the previous impact on earnings, well, you have to calculate that here in the trailing PE, but a forward one of 26.3 times. This is, of course, also a company that's expected to grow revenue quite rapidly. Compound annual growth rate 2 years out, 20%, EPS at 31%. Margins should become better and better. So AMD is definitely on that list. Now, of course, a lot of attention, just like with NVIDIA, does come to that data center part of the business. This is a part that, of course, is now becoming more and more dominant for AMD. But let's not forget the client side of things, because data center last quarter generated $3.67 billion. The client side generated close to $2.3 billion. So it still is a significant business for AMD. Of course, gaming and embedded is quite small. They face quite a lot of headwinds, which turn into a tailwind sometimes in the second half of the year. Now, if we look at margin rise, gross profit margin, free cash flow margin for NVIDIA and AMD, you can see that AMD is still far, far away from where NVIDIA is. And so for me, this gap right here is an opportunity. Again, I know it's not apples to apples. NVIDIA, 90+% of their business does come from the data center side of things, and margins there are much better. I mean, if we just look at gross profit margin, NVIDIA is in the 70s, while AMD is still in the 50s. Although, as you can clearly see, gross profit margin for AMD has been improving constantly over the last couple of years. But the story here is, of course, a free cash flow story. And I think that with the recent, well, we get insider buying, and we also get an increase for the share buyback program by $6 billion. This indicates to me that they're quite comfortable with the business. They're quite comfortable with the free cash flow, the billions in free cash flow that the business will generate for many, many years to come. That's the important part, because with free cash flow, you can do quite a lot of things. You can increase your buybacks, or maybe you can acquire other companies as well, or eventually maybe pay a dividend. But I think we still have a long, long way to go when we talk about a dividend for AMD. Last company I want to touch on is, of course, Google Alphabet. Now, I've talked a lot about Google Alphabet more recently. We've covered the Google I/O event. If you missed that, that's also going to be in the top right corner. Now, Google Alphabet, of course, if you look at the stock price, last 12 months, it's in the red. In the last 3 years, it's actually performed fine. It's up 50%. Over the last 5 years, it's up 137%. But the problem is, of course, year to date, you're looking at this, extreme underperformance over the last 12 months, underperformance as well. But business-wise, I mean, a trailing P of 19 times, a forward one of 18.5 times. This is a company that, in my eyes, is extremely undervalued. So it's the cheapest Mac 7 out there, right? On all metrics, it's the cheapest Mac 7 out there. It's cheaper than Apple, growing faster than Apple. Okay, maybe you might say, yeah, but the market believes that Apple's future cash flows are more secured than Google Alphabet right now. And I say, okay, fair point. Plus, I can also tell you that on average, the last 10 years or so, Alphabet's PE was much lower than Apple. Alphabet has an average of 24, Apple closer to the 30s. Now, why is Alphabet always discounted? That's a story for another day. But every time I look at the business, and we have looked at the business quite a lot of times more recently, well, since ChatGPT came out, the business kept on growing. Okay, the business kept on growing. Google search and other revenue, as you can see, keeps on growing. Last quarter, it grew 10% year over year. If we look at cloud, cloud is something that 10 years ago did not exist. And cloud right now, as you can see over the last 5 years, it has been growing at a compound annual growth rate of 34.2%. Okay, so this is a business that did not exist 10 years ago. This is a business that is growing quite rapidly. This is a business that if they manage to have the same margins as an Azure or an AWS, well, I'd say 5-10 years from now, this is going to become a huge business for Alphabet. And the profits, because right now, Google Cloud as a percent of the overall operating income that Google generates is quite small, right? The majority comes from search and advertising. But if this continues, well, the profits from the cloud business will become a larger part of the total profit, which would also balance out that concentration risk. And I still think that the market just does not understand that. They also completely forget that YouTube is part of Google. Then you've got, let's say, your call options on Waymo, which I still believe that less than 10 years, Waymo will be a publicly traded company worth over $100 billion. That's just my prediction. This is also a business that, if you look at free cash flow, of course, over the last couple of years have not grown by much, but it's expected to increase. Okay, in fiscal 25, it's only expected to grow 5.1%, but then it's expected to increase by close to 19% year over year, and then another 20% in fiscal 2027. Isn't that something? And remember, when we talk about Google search, it's not the traditional search anymore. Yes, it might look like the same search bar, but as you can see, this is a new way of getting results with AI overviews. 1.5 billion users a month and over 150 countries use it. It's also, right now, as they've told us, AI overview search monetization is at the same rate as standard search. That's great. There's also launched AI mode, a completely new way to use Google search. Of course, all of it is powered by Gemini, which, according to many benchmark or AI arenas, is the number one. Gemini 2.5 Pro is the number one model out there. Gemini has also over 400 million monthly users. That's up 14% month over month, not quarter over quarter or year over year, month over month. And for some reason, the market is still sleeping on this name. And this is why I'll keep on adding Google. If we go back to 150, I'll add more. If we go under 150, I'll add even more as well. And so to conclude, that's about it. What you're seeing here is the overview year-to-date performance for all of these stocks right now here on the screen. Finally, I do get my way. Apple is down 21.5%. I'm not a super Apple hater here, but I never understood why you should be paying over 30 times PE for a business that didn't grow over the last couple of years. And finally, the stock does get hit. Of course, it also got hit because of, the trade issues, the tariffs, so that adds to that. But a stock like Apple, in my opinion, should never be trading above 30 times PE because it doesn't deserve that. But okay, anyways, those are the 4 stocks. Those are the 4 reasons, or maybe 5 reasons, as to why I'll be adding more to those stocks. Same with Mercado Libre, and maybe I'll even add Uber to the list. I've been very bullish on Uber when it was in the 60s. If it somehow goes back under $80, I'll probably add more there as well. So all in all, that's about it. Do share your thoughts down in the comment section below. What companies are you willing to buy and at what price? Let me know down in the comment section below, and I'll see you all in the next one. Bye-bye.